Imagine working a regular job. Every paycheck arrives already reduced by taxes. You barely see the money before the government takes its share. Now imagine becoming richer by billions of dollars in a single year. Not thousands, not millions, billions. You would assume the tax bill would be enormous. But what if that person paid a lower effective tax rate than many teachers, nurses, mechanics, or office workers? That sounds impossible. Yet for decades, economists, journalists, politicians, and tax experts have argued over exactly this issue. How can some of the richest people on Earth legally pay so little compared to their wealth? Are they exploiting loopholes? Are they cheating the system? Or are they simply following rules that governments intentionally created? The answer is surprisingly complicated, because when most people think about taxes, they're thinking about income. The wealthy often play an entirely different game. And once you understand the rules of that game, you'll understand why some billionaires seem to live in a completely different financial universe than everyone else. The first thing to understand is that wealth and income are not the same thing. Let's take two fictional people. Sarah is a software engineer. She earns $120,000 a year. Every paycheck is taxed. Her income is visible, measurable, and easy for tax authorities to track. Now let's meet Michael. Michael owns 10 million shares of a company. Last year, those shares were worth $500 million. This year, they're worth $700 million. On paper, Michael became $200 million richer, but he didn't actually sell anything. No cash entered his bank account. His stock simply increased in value. This increase is called an unrealized gain. And in many tax systems, unrealized gains are not taxed. That single concept explains a huge portion of the modern tax debate, because the richest people often don't receive most of their wealth through salaries. They accumulate wealth through assets that increase in value. Stocks, real estate, businesses, private investments, art collections. These assets can rise dramatically in value while generating little taxable income. As a result, someone can become vastly richer while appearing to earn relatively little. Now comes the obvious question. If a billionaire doesn't sell assets, how do they pay for private jets, mansions, luxury vacations, and everyday expenses? The answer is borrowing. Imagine you own $1 billion worth of stock. A bank sees you as one of the safest clients on Earth. The bank is willing to lend you tens or even hundreds of millions of dollars using your stock as collateral. Instead of selling shares and paying taxes on capital gains, you simply borrow against them. The loan gives you cash. Loans generally aren't taxable because they're expected to be repaid. Your stock remains untouched. And if the stock continues increasing in value, your wealth keeps growing. Many critics call this strategy buy, borrow, die. Step 1, buy assets. Step 2, borrow against them instead of selling. Step 3, pass the assets to heirs after death. The phrase became widely discussed after investigative reporting highlighted how some of the world's wealthiest individuals structured their finances. Supporters argue there's nothing improper about this. Banks make loans every day. Investors use collateral every day. Critics argue that it allows enormous fortunes to grow while avoiding taxes that would normally apply if assets were sold. Regardless of where you stand, understanding this strategy is essential to understanding modern wealth. Here's another controversial reality. In many countries, investment income is taxed differently than wages. Suppose two people each receive $1 million. One earns it through a salary, the other earns it through long-term investments. They may face very different tax treatment. Historically, governments created lower tax rates for investments because they wanted to encourage economic growth. The reasoning was straightforward. If investors keep more of their profits, they'll invest more money into businesses. Businesses expand. More jobs are created. The economy grows. That's the theory. Critics argue the benefits largely flow to wealthy households. Supporters argue the entire economy benefits from investment. This debate has existed for generations. One famous example involves investor Warren Buffett. Buffett himself has publicly remarked that his tax rate was lower than the tax rates paid by some of his employees. His comments reignited debates about fairness in tax policy and became a symbol of the broader discussion surrounding capital gains taxation. Most people file taxes once a year. Maybe they use software. Maybe they hire an accountant. Now imagine having an entire team dedicated to reducing your taxes. That's often the reality for ultra-wealthy individuals. Tax attorneys, estate planners, accountants, financial strategists, investment advisors. Their job isn't necessarily to break the law. Their job is to understand the law better than almost anyone else. Tax codes can span thousands of pages. Within those pages are deductions, credits, exemptions, incentives, and special provisions. Most people never have the time or resources to fully understand them. The wealthy can hire specialists whose entire careers revolve around finding legal ways to minimize taxes. Think of it like professional sports. Everyone plays by the same rulebook, but not everyone can afford the best coaches. The result is that wealthy individuals often navigate the system far more effectively than ordinary taxpayers. Now let's talk about trusts. Trusts sound mysterious, but they're essentially legal structures used to hold and manage assets. Many trusts serve completely legitimate purposes. Parents use them, business owners use them, charities use them. However, trusts can also help wealthy families transfer wealth across generations. Imagine a family worth several $billion. Without planning, large portions of that wealth might be exposed to inheritance or estate taxes. With careful planning, trusts may reduce those liabilities. Some trust structures became so effective that governments later changed laws specifically to limit their advantages. Yet new strategies continue emerging as financial planners adapt. This is one reason enormous fortunes sometimes persist for generations. It's not simply because the families are rich, it's because they have access to sophisticated planning mechanisms that help preserve wealth over long periods. Few topics generate more headlines than offshore tax havens. Old movies often portray offshore finance as secret islands full of hidden bank accounts. Reality is usually less dramatic. A tax haven is generally a jurisdiction offering low taxes, financial privacy, or business-friendly regulations. Companies and wealthy individuals may establish entities there for various reasons. Some are perfectly legal, others have crossed legal boundaries. The issue gained worldwide attention through massive document leaks. The most famous included the Panama Papers and later the Pandora Papers. These leaks revealed how politicians, celebrities, business leaders, and wealthy individuals around the world used offshore structures. Not every structure was illegal. In fact, many were entirely lawful. But the disclosures raised important questions. Should wealthy people be able to move assets across borders to reduce taxes? Should governments coordinate more closely? And how much transparency should exist in the global financial system? Those questions remain unresolved today. Individual billionaires aren't the only players. Large corporations have their own tax strategies. Imagine a company operating in 50 countries. Where should profits be taxed? The answer isn't always obvious. A product might be designed in one country, manufactured in another, and sold in dozens more. This creates opportunities for companies to legally shift profits toward locations with lower tax rates. For years, governments competed to attract businesses by offering favorable tax policies. The result was a global competition that some economists called a race to the bottom. In response, many countries began cooperating on international tax reforms designed to reduce aggressive profit shifting. Even today, multinational taxation remains one of the most complicated areas of economics. At this point, some viewers might be thinking, if these strategies exist, why don't governments just ban them? The answer is that many of these provisions were created intentionally. Governments wanted investment. They wanted business growth. They wanted entrepreneurship. They wanted charitable donations. Many tax benefits originated from those goals. The challenge is that benefits designed to encourage economic activity can also be used to reduce tax burdens. And economists don't agree on the perfect solution. One side argues wealthy individuals should pay substantially more. Another argues higher taxes could discourage investment and slow growth. Some propose wealth taxes. Others propose higher capital gains taxes. Others argue for simplifying tax codes entirely. There is no universal consensus. The idea that rich people avoid taxes often sounds like a conspiracy. In reality, most of the story is hidden in plain sight. It's written directly into tax laws. The wealthiest people generally don't earn money the same way ordinary workers do. They build wealth through assets. They borrow instead of selling. They use trusts, investment structures, and professional advisors. They operate globally, and they understand financial rules at an incredibly sophisticated level. Whether that's fair depends on your perspective. Some see these strategies as rewards for investment and risk-taking. Others see them as evidence that the system favors those who already possess wealth. But regardless of where you stand, one thing becomes clear. The question isn't simply how rich people avoid taxes. The deeper question is why the rules allow it. And that debate is likely to continue for decades to come. If you would like a new video about a specific story, please leave it in the comments. Also, you can subscribe to help me make better videos. See you in the next one.